30 years in the investment industry has taught me there are 4 key building blocks to any successful investment portfolio. Robustness, discipline, controlling how you use manager skill to add value, and low costs. By robustness in a portfolio, what I mean is putting together the right mix of assets. So not only does it align with the risk requirement a client's got, but also generally it has the ability to withstand shocks and doesn't get derailed unnecessarily by events. So if we think of an obvious risk to a UK investor, it will be a UK economic crisis. Now, in the event of a UK economic crisis, you could probably expect 2 things. Price of assets in the UK would decline, and sterling, the pound, would probably fall in value. Now, if you had a poorly diversified portfolio that had all of its assets in the UK, you would have a very nasty double whammy in that situation where you'd lose money on your investments and you'd probably be exposed to higher inflation because you would have the impact of a fall in the value of sterling driving up the price of imports. Now, if you were globally diversified and you had assets all around the world and in lots of different currencies, not only would he have exposure to countries that weren't directly affected by the UK economic crisis, but you also would have exposure in currencies that if sterling fell, the price of those investments in pounds would rise. So you've immediately got a much more robust portfolio as an example. And if you think back to Brexit and the time that vote was announced, one of the biggest impact in many ways was a large fall in sterling. So these are the kind of things we could expect, and it's really important that you set portfolios that can withstand events like that. So robustness, very important. Discipline is really about respecting how you make money and where returns come from as an investor. It doesn't matter what investments you buy, where in the world, to some extent you're always exposed to the same thing, which is global economic growth. And over time, global economic growth is very predictable, and it means that returns from investments, if you hold them for long enough, are also quite predictable. So whilst in any one year, investments can go up and down a lot, if you zoom out and look at a rolling 10-year period, for example, you'll see that actually the average returns that you'll get over that period become far more predictable. So if you want the lowest risk way of achieving your objectives as a client, probably the best way to do it is to get a robust mix of assets that aligns with your risk requirement and just hold on to that and don't change it to ensure that you access the benefits from global economic growth and you don't make any mistakes. Now, having said that, we do think there are lots of opportunities for managers with skill and experience to add value to clients by changing portfolios over time, to increase exposure to assets that they consider to be cheap, and to decrease exposure to assets they consider to be expensive. And this can improve return and reduce risk. However, once you start looking at the world and understanding how important discipline is, it means that the way people use manager skill must also be tightly controlled to ensure that the manager themselves doesn't become the dominant source of risk in portfolios. So we like managers who are skilled and experienced, but we like them themselves to be patient and to control their input into a portfolio to ensure that the portfolio stays on track long term. Lastly, costs. Now, costs of all the things that I've talked about are the most predictable impact on portfolios. And as a UK investor, you probably have 3 areas which are a source of cost for you in investments. One is the platform, including the tax wrappers that you might have. The second is the investment manager charges for putting the solution together for you. And the third is what the cost of the underlying investments are. Now, all 3 of these should be tightly controlled and they should all be low cost. In particular, the underlying investment exposure, it can make a big difference how you buy that. If you think of the world how we've described it, about trying to get exposure to asset classes, actually you can do that now very cheaply through passive investments. And we would expect most portfolios to have a large amount of their assets in passive investments, and it's an important way of reducing the total cost. So, I've covered today what I think the recipe is for a successful investment at a high level: robustness, discipline, how you gain access to manager skill but control it to make sure it doesn't itself become a source of risk, and making sure you have low costs for your investments. I've only covered them at quite a high level. If you've got any questions about any aspects of this and you want to speak to me, please get in contact. I'll be delighted to talk to you or reply to emails. If you like the content that we put out and you don't subscribe to our videos, please click on the flying colours icon and you'll automatically be added to the list and become a subscriber. And lastly, I must remind you that today I've been talking about investments and your capital is at risk. Thank you.